effectively, I think that what's interesting from my dynamic is that when we went into the US, we wanted to go in with a differentiated philosophy. And that differentiated philosophy was, how do we go to the other side of the world and not lose our money to start and not lose our clients' money? And bearing in mind that people that have moved money overseas typically want to call that their I'm in shit money, or this is my lost money, this is my legacy money, this is my God forbid money. And I think those are all very interesting dynamics to think about, where people are not using that as an investment to typically grow only their wealth, but certainly to also preserve their wealth. And I think we as Infiniti need to be the custodians of that trust, and we've got to make sure that we deal with it in that kind of way where their expectation and our expectation are directly aligned, where we respect the fact that they've worked hard for this money and it's taken a long time to get the courage to externalize the funds, and they want it as a preservation of their wealth and kind of a differentiator to the extent that they want to look at it as, I'm going to use an inverted commas, an insurance policy, that in the God forbid situation that something terrible happens in sunny South Africa, they have some sort of fallback position to be able to look after themselves and their loved ones in a first world, first tier currency, in a strong asset class that can deliver kind of not only an income, but also a capital upside. They're two separate and very differentiated offerings that Infiniti has and typically have given to our clients. The first being a development opportunity where the risk reward is significantly different, because you are going to be involved in buying into a project which has got significant risk related to delivery of new units which are going to be built on the other side of the world. So one of the projects that we completed on is Kingsport, but effectively we're building some multifamily units in a place called Kingsport, and that's in the Tri-Cities area. The kinds of assets that those clients want to buy, they're happier to take significantly more risk to get significantly more returns. The more risky the project is, the more returns it should show on paper. So people are directly rewarded for taking risk by giving them higher returns. What we're trying to do is we want to try and get the maximum return with the minimum risk. And how do we do that? And what do we do to minimize the risk and maximize the returns? And what we have been doing and continue to do is a fantastic diligence on not only the developer, but also the city, the rentals, the amount of depth in the market, the comparables, what kind of construction will be used, what kind of debt can we get, what kind of offtake can we get, what kind of rentals will be sustainable, what kind of absorption, which is the amount of rentals per month, will be able to be taken up when the project is complete. And we take that as a blended look and say, on these criteria, how does the project look from a due diligence perspective? And on a risk-adjusted return type basis, we make a decision of, should this be an investment that we want to put forward to our customers or not? We have an investment committee. We look at these risks in detail. We do a full due diligence, which is a really in-depth dive into how these assets should be priced, what the real risks associated are to the project, what is the big employers in the city, what are the big drivers of the economy, is it a first, second, third tier market, is it going to be a B, C type product, how do we mitigate some of the risk? And in the Kingsport deal, we have a very special opportunity. The special opportunity is that the city of Kingsport gave us a 20-year tax abatement that we don't have to pay property tax for 20 years, which makes the returns on the project long-term significantly better. And therefore, when we look at our risk-adjusted return, instead of a very vanilla type deal that we would have done, you now can add these tax abatements and tax holidays that the city is going to give us in terms of property tax into the cash flow of the asset after completion for the next 20 years. And when you look at it, that in concert with everything else that we look at, it really changed the dynamic of something that was very benign and vanilla into something that was actually a 7-8% kind of return, which in that market is currently trading at a 5-6%. So from that perspective, we looked at the risk, we looked at the risk-adjusted return, we looked at the margin, we looked at the opportunity, we looked at the size of the deal, we looked at the debt. We really analyzed it deeply. We saw the big employer in the city. We looked at what else has been built. We looked at the comparables. We looked at the rate per square foot in the rentals. And we decided that through our investment committee, we were going to attack that as a priority.